Hello again, everyone. Tony Marlette Jr. here at Brookside Tax and Financial Group. Let's get right to the November market update. If we take a look at October, markets were down across the board, especially after a pretty volatile final week of the month. We were hoping for a positive October after the September that we saw, but interest rates, along with inflation, of course, continue to be the trend. It's the predominant factor contributing to both stock and bond market performance. Treasuries are elevated, and that's good for people who are collecting income off of those assets. As we've talked about before, it is contributing to negative bond performance year to date and also an inverted yield curve. We saw geopolitical risk rise significantly for the second time in about a year and a half with the Israel-Hamas conflict. Obviously, any market risk is going to be very secondary to the effect that it's having on the people that live in that region. It does matter globally to markets, though, especially here in the United States, if there could be potential United States involvement at some point. Earnings have been the story, though, for the market on a positive note for the better part of this year. They've still continued to generally perform above expectations. And while it may be hard to see that through the year end, we are seeing a little bit of a mixed picture for markets right now. Consumers are still strong. Spending is still elevated, leading to the strong earnings. But some pitfalls include the job market. Although some of that looks good on paper, we're seeing layoffs, recession projections, and rising rates, making it harder to borrow, like we saw, like we mentioned in last month's market update as well. And people realizing that being risk off is not a bad place to be right now. The same 7 stocks are propping up the S&P 500 to a historic standpoint here. So the other 493 are not keeping up. So keep this in mind when you're looking at your market performance. Remember to be prudent and stay in line with your overall risk objective. Although cash rates are high right now, cash is still likely to lag market performance, especially over the long term. Speaking of long term or even intermediate term, the best place for investors to be right now that fall into those categories are incorporating lower risk assets with higher risk or higher growth assets. And if you'd like to review your situation with us and see what makes sense for you, I encourage you to do so. You can visit us online or check out our YouTube channel and our Facebook page as well. As always, reference this video and your consultation will be at no cost to you. We look forward to working with you, and we thank you for continuing to work with us.